Next one, a little more complex, depreciation. So let's say I buy a building, or in this case, maybe I'll have a specific example. Let's say I buy a building that has a 60-year useful life or a 100-year useful life. I'm going to use that for a long time. So it doesn't make sense. I don't have something like supplies or a monthly period that I can really allocate to this. I have this really long lived asset. And so we have to determine, and that asset has a value at the end of it. I could sell it. Like I have a house, I could sell the house at the end of its life and maybe make money off of it. And so we have to determine what our depreciation is for that asset, because when we buy that expensive asset, we can't expense it on day one. We expense it based on its useful life. And so we calculate the straight line expense. There's other ways to calculate depreciation. We calculate the straight line expense by the asset cost. So let's say I bought $1 million home and I expect to have it for 60 years. And at the end of its life, I'm going to run it ragged. I'll expect it to be worth $100,000. I'm not expecting based on fair value adjustments. I remember historic cost. I have to base it off of the historic cost. And let's say I say it's a 90-year useful life. I'd give it $10,000 of depreciation each year. That's all. So memorize this formula. I'm not going to ask you to determine what the useful life is. I'll give you that. It's a very complex judgmental area of accounting that you'll learn later how to determine useful life. But in theory, the useful life is just the period of time that it's expected to help you generate revenues. You're generally going to use a comparable. So we'll look at what other companies are using as useful lives and just use that. So you might think a computer might have a 3 or 4 year useful life because computers upgrade quickly. But a building or land, a building will have 50 to 100 years useful life, depending on the building. And then land has an infinite. You don't have depreciation for land. It's expected to always have value. The salvage value is what it is expected to be worth at the end of its useful life. It'll be given to you. It's also known as scrap or residual value. And that's it. And so we can do this example. This company, fast forward, bought $26,000 of equipment. The equipment is expected to be worth $8,000 at the end of its 5 years, which is its useful life. 12 months times 5 is 60 months. And then so how do we determine the straight line expense? We just take the 26,000 minus the salvage value. We get our 18,000. Then we take that 18,000 divided by the 5 years or the 60 months here. So it's $300 a month in depreciation expense. So then the question is, what are these journal entries? So there's two transactions here. What are the two transactions? What's the first transaction for the purchase of equipment that we have to assess?
Buying with like paying cash for the equipment.
Yeah, it's perfect. And that's a secret to accounting. There's lots of secrets, but the secret is if you're spending cash on something, that's your first thing you're going to assess. Or if we're buying something, if we're getting something or spending cash, it should be a giveaway that's our first transaction. So we bought equipment for cash. So what's the journal entry for that?
So you credit the, I know you debit the equipment and credit the cash.
Perfect. Exactly. Why? Because the equipment is an asset. Assets go up with a debit balance. The cash is an asset. Assets go down with the credit balance. It all ties out. Financial statement impact, nothing. So what's our second transaction? Now a month's gone by. What's our next transaction? Good job. That was a really good answer so far.
Depreciation expense.
Exactly. So a month has gone by. We've used the equipment for a month. That equipment in theory has helped us make money for our business, or else we wouldn't have bought it, right? And so we're going to have to match that expense to the revenue it's created. So that month of depreciation expense is our next transaction, correct? And what would that journal entry be? Always go for the easy ones. There's always an easy side to an answer. So we know that there's a depreciation expense. There's got to be, what's one side of the equation?
Debit?
Yeah, there's always going to be a debit. And what's that? And what is the debit for an expense?
Um, accumulated depreciation.
The debit will just be depreciation expense.
Oh,
Expenses are always debits. Easy. So if we have an expense, we know that we need a debit. Your debit's always going to be your expense. You're solid. Done. So we now have one part. One part of your answer is correct. What's our credit? Our credit is something called accumulated depreciation. What all that is we're actually reducing the value of our equipment account.
The new value of the equipment.
Yeah, so we're tracking them separately, but this equipment will reduce the accumulated depreciation will reduce the value of an equipment account. This accumulated depreciation account's something called a contra asset. And the only reason we have it instead of just reducing equipment directly is just for reporting purposes. Because someone might ask us in the future, like, hey, how much did you buy that equipment for? So we keep it separate. And they say, how much depreciation is on it? We keep it separate. Important to note, this does not approximate the fair value of the equipment. It's just how we're tracking it for accounting purposes. Equipment might have gone up in value or down in value in time over time, right? We're not trying to figure that out here. We're just trying to depreciate the equipment.
What is the definition of contra?
The opposite of. So a contra asset account is literally the opposite of an asset.
Thanks.
No problem. It's a lot of terminology. Just memorize it. It's a language. Accounting is called the language of business for a reason. And then this is how it would show up. So you'd say, this is called the gross number. Equipment would be gross of 2,600. And let's say they had 900 of depreciation. The net value of the equipment would be 25,100. So you'd show the gross and the net number. Let's see. And there's some practices here, which I'll let you go through yourself, or I can spend some time after. Let's see. So let's go over some more examples that I think are important. I want to go over one of each of the big accounts. Unearned revenue. So this is an example I keep using, the 1 million in revenue. So what if we received cash in advance of providing products or services? So here they made a lot less than I was proposing. They gave a 60-day fee advance covering periods 12/27 through 2/24. So three grand ahead of time. Fast forward. So the journal entry here is debit cash, 3,000. And then because we haven't provided those services yet, we credit unearned revenue, also known as deferred revenue, by 3,000, which is what account is unearned revenue? Is it a liability, asset, or equity?
Liability.
Liability.
Liability. Perfect. That's how we should be thinking all the time. Connect all the dots. And so then we're earning it by day. And so then at the end of the month, we have to calculate, we have to do an adjusting entry to determine how much revenue we earned. And so that adjusting entry would be calculated. The number would be 5 divided by 60. We had 5 days left in the year, divided by 60 times the amount. So we'd have 250. So what would be our adjusting, and what would be that adjusting journal entry? What's the adjusting journal entry for that 250 bucks? Remember, debit, just think debit or credit. What's the debit?
Will the 250 be the
Credit. Credit.
Well, there's going to be a debit and a credit always. So what accounts? This is a hard one. This is one of the harder ones. I want us to thinking. We got to think through this. So what's being reduced? What's being reduced here?
Credit.
What?
The equipment's going to be the credit because it's got the value of it decreases.
We're not doing equipment anymore. We're doing revenue.
Oh, I'm sorry.
Yeah, no worries. We're doing the advanced fees. And so the debit, someone put it, the debit's going to be to unearned because we're reducing our liability. Liabilities are increased with a credit. They're decreased with a debit. So ask what's happened here. We've earned some of the revenue, so we get to reduce that. And then we get a credit what?
To cash or?
No, always ask yourself, did any cash change hands at this? Nope.
Oh, right.
Oh, good point. Good question though. Everyone's going to do that. most common plug students use is cash. It's not cash.
Then is it customer revenues?
Yeah, you can have revenue. Yeah. If we earned it, it's revenue, right? Unearned revenue turns into revenue on the adjusting journal entry. Perfect. So we debit our unearned revenue, decrease it, and then we credit our revenue, which increases our revenue. And you can see that here. Consulting revenue would go up at the end, and our adjustment, our unearned revenue would go down. This would be our journal entry, our adjusting journal entry. The adjusting journal entry is when cash isn't changing hands. And then here's more examples. So just practice the examples on your own. Accrued expenses. So there's some expenses that we accrue before we pay. That's what an accrued expense is. What's the most common one? It is salaries expense. Whoever's had their first job knows the painful experience of it taking you a month to get your first paycheck, right? Because why does it take a month? Because the employers pay you generally at the end of 2 weeks or 3 weeks in arrears. And so it takes you a week to get processed and another few weeks. Who's that beneficial for, by the way? It's beneficial for the employer, right? They get to use your services and you didn't get any money. It helps their cash flow. For consulting, I generally want to be prepaid. That's advantageous for me. I get cash without performing services. This is all negotiable. So let's make sure. The accrued salaries expense. So what does an employer have to do at the end of every year or end of every month? They have to determine what they owe to their employees but haven't paid. That's an accrued expense. What you've owed but haven't paid. No cash changes hands, so you'll never have a cash piece in your journal entry. What we will have, though, is we'll be debiting our expense for the amount that we owe and then increasing our payable, crediting our payable, our liabilities. So we owe more, and we're going to recognize the expense because we've incurred it. And so this example, they just calculate the amount of days. 3 days at $70 a day is $210 they owe to their employee. So that's an adjusting entry of debit our salaries expense, 210, credit our salaries payable. And then when we pay it, when we're paying it, let's not take out the actual salaries expense. Let's just say if we're paying the payable, we just reduce the liability. So we debit the liability. That's a reduction of liability, and we credit cash. When we pay it, that's when we credit the cash in the future. And then if we are including another portion of the salary, so in this example, we have what we owed from the last period, plus we've incurred some more expense and we paid $700 cash, then we would also debit an expense for the increased amount incurred. Any questions? Just practice these. Making sense though? Are we getting understanding the assets equal liabilities equity, having the theme of this, just to bring it all back. I know it's a lot. Just these are just the adjusting entries. At the end of the day, because of accrued based accounting, we're going to have some differences at the end of a month for things that we owe but haven't paid cash for, or things that or revenue that we have earned that we haven't received cash for. And so we have to make these adjustments. There's other adjustments we can look at, other types of accrued revenue. So, and there's always examples here. So go through the slides. I've given you all the answers. The accrued service revenue, accounts receivable and consulting revenue. So let's say at the end of the period, I've performed a service. I billed the customer. But I do this right now. I have a consulting service where let's say I bill $200 an hour, but they pay me net 30 days. They pay me after 30 days. So at the end of a month, let's say I've earned $1,800. I've earned it. I have a right to it. I've billed the client, but they still have 30 days to pay me. I'll have a receivable. I'll have an asset where I know I'm owed $1,800, and then I'll have revenue of $1,800. A receivable is an asset, so debit increases it. Revenue is always a credit. Does that make sense? From a business standpoint, you want to get cash as much as you can. Your goal, as any person in any job, should try to get cash as quickly as you can, collect on the cash, and try not to pay, right? Pay as long as you can. Get your longest payment terms with no interest and get as much cash as you can up front. That's how you run a successful business. And then this shows you the financial statement impact, which I've gone over a few times. Then when you receive the cash, you increase your cash and you credit your receivable. Your receivable will go down. And that's all fine. Then here's just the theory of how you'd go about then creating the adjusted trial.